My name is Dan. I'm the Customer Learning and Development Consultant here at RightCapital, and I'm thrilled to be here with all of you for today's educational value add webinar focused on all things client settings. In particular today, we're going to be spending the majority of our time looking over the different methodology settings within a client plan, and we're going to go over every option that you have for each setting and also take a look at the impact that these settings will have on the plan itself. So if you're someone who's a bit newer to RightCapital, this is going to be a great opportunity to learn a bit more about the methodology settings and to see how your choices there will impact the output of your client plans. And of course, if you're someone who's been with RightCapital for a while, this should be a useful refresher for you. Having a thorough understanding of these client settings is really a crucial step in ensuring that everything that's happening in your client plans is both precise and intentional. That being said, before we dive into the presentation today, let's take a quick look at our agenda. We're of course going to be providing that in-depth overview of each of the methodology settings within a client plan today. While we're doing so, we're going to also touch on the nuances, the impacts of these settings and their various options on the cash flows in particular, but also on the plan as a whole. We're going to touch on customizing your global client presets within the advisor portal. And we're also going to touch on adjusting the default client notification settings and permissions as well. Of course, as always, we will be doing a live Q&A at the end of the presentation today, so please don't hesitate to write in with any questions you might have. You should see a questions field in the GoToWebinar control panel on your screen, and I'll be sticking around to answer as many questions as I can until the top of the hour. Okay, I am just going to take a quick moment here to switch over to my RightCapital login, and then we can get started. Perfect. So here we are in my client plan for today. We're looking at a joint plan for Isaac and Elaine Hale. And we're going to start by going straight to our methodology settings. So within a client plan, you can always find the methodology settings by clicking into the gear icon in the upper right corner here, and then going to the settings tab here. And that's going to take you directly to the methodology subtab. And this is really home to all of our various methodology settings at the client level. This is where we're able to adjust the calculation options for just this particular client household for Isaac and Elaine. So we're going to be going down the list today and taking a look at every single one of these settings, but we're going to dedicate some time first to diving a little bit deeper into these top 6 settings on this page here. All of these settings are important in their own way, but I would say that these first 6 are really the major settings to be mindful of that are going to have the biggest impact on pretty much every client plan, regardless of how simple or complex that plan may be. And the first of these settings that we're going to be looking at today is the planning method. So this setting in particular determines what will happen within the plan to excess cash flows on a yearly basis. And we've got a few different options here. The first option that we see and the default option in RightCapital is modified cash flow based. And with this option selected, any excess cash flows are going to be assumed to be spent off on a yearly basis. So just to demonstrate what this looks like, I am going to open up our retirement cash flows here in a separate tab, and we're going to toggle back and forth and see the impact of some of these different options here. So with the modified cash flow based option selected, in our cash flows summary here, we can see that Isaac and Elaine currently have more income coming into the plan than they do expenses and goals. Their inflows outweigh their cash outflows for the most part on a yearly basis here. And while we do have some taxable savings occurring, which are reflected in this far right column, we also have some surplus. And currently, we're assuming that that is being spent off. And that's reflected here in this spend unsaved cash flows column. So that's what the modified cash flow based planning method is going to do for us. On the flip side, we also have a cash flow based option, which does the opposite. We're going to assume in this case that any excess cash flows will be automatically saved and reinvested into the client's taxable investments. So let me quickly save that change, refresh our cash flows here. And now we see that that spend unsaved cash flows column has been eliminated, and instead that surplus is now reflected in the net flows column, which is where we see those taxable savings that are being reinvested. So those are the two cash flow based options in RightCapital. They do function in mostly the same way. These are both cash flow planning methods in general. The main difference is what's going to happen to those excess cash flows each year within the plan. The third option here, this one is the most different and is really more of an alternate way to create plans in RightCapital. So the goals-based planning method is not a full cash flow, comprehensive plan. This is going to eliminate the need to enter income and expenses upfront when doing the data entry for this plan. You only need to specify the client's savings, the client's goals, and of course, their assets and liabilities as well. So with this option selected, we're going to see some differences back in our cash flows here. Instead of having the cash flow summary page with all of our inflows and outflows, we now only see two of our cash flow subtabs. We have our net worth subtab, which is going to highlight the balances of our non-qualified and qualified assets, as well as properties, loans, and other assets as well. And then we have our accounts tab where we can see the ending balances of each account bucket, as well as the movement of money in and out of our various account buckets as well. So the goals-based method is a little bit more of a simplified planning method compared to the cash flow-based methods, but it does also take less data entry up front, so there's a bit of a trade-off there. The main thing to keep in mind when it comes to goals-based, in particular in RightCapital, is that this planning method does prevent you from using some of the other modules outside of the retirement module. Things like the insurance module, for instance, and the tax module. Any module that relies on income and expense information to function will not be usable. So that's the only thing to be mindful of there. But that being said, goals-based can certainly be useful in those cases where maybe you don't need to do such a comprehensive analysis. It allows you to essentially say, here's how much money my clients have today, here's how much they're putting away, and how much they want to spend in retirement, and can we do it? So there's always that option there for you, in those cases where you want to do a goals-based plan rather than a cash flow-based plan. The last thing I'll say about the planning method before moving on here is that the modified cash flow based method, which is the default setting, is really the one that gives you the most control over the cash flow excess in the plan. Now, the cash flow based option, this is always going to save and reinvest every penny of excess. But the modified cash flow method, you can add taxable savings cards to tell the system exactly how much of a client's surplus you'd like to save and for how long. So there are use cases for both options, of course, but the modified option does give you the most flexibility in that regard. Perfect. The next setting we're going to be touching on is our withdrawal sequence. And this is really going to go hand in hand with the planning method. While the planning method determines what happens in years where we have, surplus cash flows, the withdrawal sequence determines what happens in those years where we have cash flow deficits. Specifically, what is the order of operations in terms of which accounts we're pulling from whenever the client's expenses outweigh their income in a given year. So the default selection here is going to be this first option, taxable, tax deferred, and then tax free. This sort of sequence does tend to be the best option in many cases, but it is, of course, plan dependent. So we'll take a look at the differences with another option here. So let me save that in place and refresh our cash flows just so we can see what it looks like with that default selection here. Let me click back into our retirement cash flows area. Perfect. And then in our summary page, we can see that starting in 2035 here, when these clients retire, is when we start to have some cash flow deficits occurring within this plan. And if we move over to the accounts area of the cash flows, we can actually see, if we switch to the withdrawals from accounts, that money coming out of the taxable bucket first, compared to the 401ks, which are part of the tax deferred bucket. So it will only move on to those tax deferred assets once the taxable assets are fully depleted. But of course, we do have some additional options here, which sort of mix and match our different account buckets depending on the order of operations you'd like to see. So just as a quick example for all of us here today, if I switch over to the tax deferred, taxable, tax-free option at the bottom here, that's going to flip-flop the order that we see. So I'll save that, click back into our cash flows, and refresh my page here. And now we see that, once those cash flow deficits begin to occur, instead of pulling from that taxable bucket first, it's pulling from the tax deferred bucket first. And it's only going to start pulling from that taxable bucket once the tax deferred bucket is fully depleted here towards the end of the client plan. So you have some flexibility to, play around with different withdrawal sequences and see what fits best for, of course, your unique, planning philosophy, but also for the specific client plan that you're working on here. I do want to quickly mention in regards to withdrawal sequence that within your client plans, you do always have the option to add distribution cards to, tell the system exactly how much money you'd like to withdraw and from which account bucket you'd like to withdraw it from. And that will always overwrite the withdrawal sequence. So just something to be mindful of. In the profile income area in particular, this is where we're able to add income distribution cards. I have a distribution in here for $50,000 in 401k withdrawals occurring at age 75. And this will always overwrite the withdrawal sequence when you add these manual distribution cards within the income section of the profile. The withdrawal sequence, for all intents and purposes, is really, the safety net. It's what the system will fall back on whenever there are cash flow deficits in years that there aren't manual withdrawals occurring. Perfect. The next setting that we're going to be looking at here is the allocation method setting, this third one down on the left-hand side. And this is a really important setting because this determines how RightCapital is going to project a client's asset allocation out into the future. So there's a couple different options here. The default selection in RightCapital is this first option for same allocation for all years. And I'm actually going to click into the investment module in my other tab here for this particular setting, just because this is the best place to really illustrate the impact of this setting. And just to start things off here, in the investment asset allocation tab, this is where we can find the client's current allocation. Now, this is a blended overall investment allocation based on all of the non-annuity investments that you've entered into this client's plan. And we can actually see the overall rate of return that we're receiving here for their current allocation beneath the pie chart. So what we see with this first option, same allocation for all years, what this option is really doing is essentially taking the way that the clients are invested today, their current allocation, and it's going to project that out as the long-term rate of return within the client's plan. And we can see that visually a bit better within this allocation path tab here. This area is going to show us in a nice visual here what the client's allocation looks like over the duration of their entire plan. And with that same allocation setting selected, we can see that this is not changing. It's the same allocation, that 68-32 split between equity and fixed income throughout the duration of this client's life. So let's take a look at some of these other options here and see the impact that that has on the client's plan. The first of the other two options is the glide path option here. So with this option selected, what we see is a more gradual transition, typically from more aggressive to more conservative over the course of the client's plan. So you can actually choose which glide path you'd like to use when you select this option. So if you have built any custom glide paths in your advisor portal, those will be options for you to select here. And then you can choose a grading schedule as well. How quickly do we want to transition from the client's current investment allocation to the specified glide path allocation? So once we have that dialed in, we can click Save. And then if we refresh our page here, we'll now see that gradual transition, right? From more conservative earlier on, or rather from more aggressive earlier on to more conservative as the clients get closer to the end of their life here. The last option that we have for the allocation method is the pre and post retirement allocation option. And this lets you do something similar to the glide path, except it's more of a hard switch rather than a gradual transition. So with this option selected, the pre-retirement allocation for the current plan is always going to be the client's current allocation, how they're invested today. And then you'll have an additional option here to select the post-retirement allocation for the current plan. So maybe we want to use a moderate allocation, for example, in retirement. We can select that here within our settings. And then if we click back into this allocation path tab one more time, we can see now there's a hard switch happening. We have that current allocation for the pre-retirement years receiving that 8.2% annual return. And then in the year of retirement, there's a hard switch from the current allocation to that moderate allocation. And then going forward, that's what we're using for the remainder of the plan. So in those retirement years, we're switching to that 7.7% annual return going forward. So lots of flexibility here in terms of how we project that client's asset allocation out into the future. One thing I do want to quickly mention before moving on, when you're entering a client's investments into the profile net worth section, you do have to manually allocate those accounts if you're entering those accounts manually. So just something to keep in mind, there's always going to be an asset allocation menu here at the bottom where you can specify what the allocation for that particular account is. If you're linking the client's accounts or using an integration to import their accounts, that should all feed in automatically, but just be mindful that if you're taking a quick look at a client's current allocation and you see a lot of gray, you see a lot of other in their allocation, just double check the profile net worth section and make sure that all of those accounts have been properly allocated. Perfect. Great, so our next setting that we're going to take a look at here is this top right setting, the cash flow in simulation starts setting. And really all this means is what date do we want our cash flow projections to begin? So let me quickly toggle back into our retirement cash flows in my other tab here. Perfect. So the default setting in this, for this particular option is January 1st of this year. And this is a retroactive setting. This is essentially going to say that for year one of our cash flows, we're starting on currently in 2024, January 1st of 2024. And as a reminder, the cash flows in RightCapital are annual. So every year here is always going to be 12 months. So for year one, for example, we have January 1st of 2024 through December 31st of 2024. And each year is going to be exactly one calendar year. Of course, there is another option here for January 1st of next year. So this option in comparison is proactive rather than retroactive. Instead of looking back to the first of the current year, we're looking ahead to the first of the following year. So if I refresh my page here, 2024 is going to vanish from our cash flows, and we're instead going to be starting on January 1st of 2025. The third option here, which is the most different option, is the current month or the rolling 12 option. And this one is the closest to real time. It's going to use the first of the next month as day one. So I know that the title here is current month, but don't be confused by that. This is a slightly proactive option. So today, July 26th of 2024, if we were to select this option and then take another look at our cash flows, the first date of our cash flow year one is going to be August 1st. So it's actually looking ahead to the first of the next month. So 2025 then, year one of this plan is actually August 1st of 2024 through July 31st of 2025, which makes year 2 labeled 2026, August 1st of 2025 through July 31st of 2026, and so on and so forth. So that's how the rolling 12 or the current month option works. Just in terms of general practical use cases for each of these. In my experience, most advisors do tend to stick with the January 1st options. Some advisors will actually use January 1st of this year in the earlier half of the calendar year, and then actually switch to January 1st of next year in the latter half of the year. And the reason that advisors do this is to better align the client's balance sheet, the current balances of their assets and liabilities with their cash flow projections, especially if the client's accounts are linked and those balances are updating automatically in real time. Switching to the January 1st option, or the January 1st of next year option, as we approach the end of 2024, will help to ensure that the year one account balances aren't overstated. It makes sure that the projections aren't accounting for any additional savings and portfolio return on top of what's already occurred so far this year in reality. So just something to be mindful of with those those timing options for the cash flow start date. Of course, the current month setting, that rolling 12, does mostly mitigate that issue of overstating or understating a client's current assets and liabilities. The one thing to be aware of with the rolling 12 option is that certain cash flow numbers will be slightly offset depending on what point in the year we're in. And the cash flows will shift automatically on a monthly basis rather than a yearly basis. So you will see changes occur more frequently with the rolling 12 option selected as opposed to the January 1st options. One last thing to note here before moving on from the cash flow start date. When you're using these bottom two settings in particular, January 1st of next year or the rolling 12 option, any income, expenses, or goals that have a start date of 2024 will be ignored within the plan when using either of these options. Because these options are both proactive, looking ahead, anything with a past start date will be assumed to have already happened. So just be mindful that if you are using January 1st of next year or the rolling 12 setting, you will want to use 2025 as the start year for the majority of your profile cards, rather than 2024. Great, so that takes us to our next setting here, which is the planned distribution method. In particular, this setting controls how RMDs and manual distributions interact with one another. So if you'll remember from a few minutes ago, I pointed out that in the profile income area, you can always add manual distribution cards to tell the system to distribute a certain dollar amount from a certain account bucket during a specific time frame. So these will be added to the cash flows. But as a reminder, RightCapital does also calculate RMDs automatically within your client plans as well. So in years where we have both manual distributions and RMDs occurring at the same time, we can tell the system how we want those things to interact. So I'm going to scroll down to the planned distribution area of the cash flow summary page here. And if I click into the 401k section here, we can see that in 2045, when Isaac is 75, we have both RMDs and a manual distribution occurring at the same time. So with the current option that I have selected, RMD added to manual distribution, any manual distributions are added on top of the automatically calculated RMDs. And that's exactly what we see happening here in 2045. We have 102,000 in RMDs that are being generated in addition to that $50,000 manual distribution that I've entered into this client's profile, which is resulting in a larger overall distribution at the end of this calendar year. The second option here, the greater of RMD and manual distribution option, this one is essentially going to pick whichever amount is higher, the RMD amount or the manual distribution amount. And if we refresh our cash flows here and take another look, what we'll see happening is the amount of the RMD will actually be reduced by the amount of the manual distribution. So in this case, because that $102,000 RMD amount is higher than our 50,000 manual distribution amount, we still see that $50,000 distribution so that we can visualize that happening in the plan, but it's going to reduce the automatically calculated RMD to bring us up to that total 102,000. So visually, that's how this looks in the cash flows. But at the end of the year, it's essentially choosing the RMD amount over the manual distribution amount because it is the higher dollar amount. The last option here is essentially just going to turn off the automatic RMD calculations. So for any reason, if you ever need to manually enter a client's RMDs and turn off those automatic RMD calculations, you're able to select that no RMD option. And then if we refresh this page, those automatically calculated RMDs are going to be eliminated from the plan, and we'll be left with just our manual distributions. Perfect. Most of the time, the greater of option is the one that I tend to see most advisors using, but depending on the plan and what you need to see, you can of course choose the most appropriate option for that client. Perfect. That takes us to the last of our big six, which is the cash management method. And this setting in particular determines how the cash portion of a client's taxable bucket is going to be treated within the plan. So as a reminder, the taxable bucket is made up of cash plus the client's taxable investments. And we can actually see that in the cash flows accounts tab. Let me quickly refresh my page here. And if I click into the taxable column here in the accounts area of the cash flows, we can see those two portions of the taxable bucket, the cash reserve portion in addition to the taxable investment portion. So, what we choose here for our cash management method essentially determines, what's going to happen with that cash reserve, portion of the taxable bucket. These treat bank account as cash options are both similar in terms of how they function. They are essentially going to take the bank accounts that have been entered into the client's profile. So in this case, these couple of checking and one savings account, and it's going to treat those as the cash reserve. Those are going to grow at your cash rate of return as you've specified in your return assumptions. So in this plan, that would be this 1.66% here, and within the cash flows here in the taxable bucket, we can see that cash reserve at that 55,000 plus growth for a duration of time here. The main difference between the two different bank account as cash options is what happens in terms of spending. So we can choose whether or not we want the cash to be spent off before the taxable investments or after the taxable investments. So, currently I have it set to spend cash before taxable. And in our, accounts tab here, we can see that when these negative net flows start occurring in 2035 here, when these clients retire, the cash reserve is being spent pretty much immediately. And if we switch to the withdrawals here within this table, we can see that once those deficits kick in, the cash reserve is being immediately depleted, and the remainder of that shortfall is coming from the taxable investments, as well as going forward within the plan. But if I switch over to our spend cash after taxable, and then refresh my page here, we're going to see that that cash reserve is going to be sheltered. Instead of spending that off like we are currently, if I switch back to the ending balance by accounts, we actually maintain that cash reserve that continues to grow unperturbed throughout the duration of this plan. And if I switch back to the withdrawals from accounts, we can see that in this plan, our taxable investments are adequate to cover our outflows throughout the entire duration here, and we're never having to dip into the client's cash reserve, their bank accounts, to fund any of those cash outflows. So that's the primary difference between these two options, what we're spending first in terms of cash or taxable investments. The third option here is the cash reserve goal option. And if you're a RightCapital veteran and you've been with us for quite some time, you may remember that this was previously the only option here for the cash management method. And this one does function the most differently. This is actually going to add an additional goal card to the profile goals section that we can use to tell the system how much we'd like to keep in cash throughout the duration of the plan. So I'm going to click into my other tab here and navigate to the profile goals area. And with that cash reserve option selected, a new card will appear here, the cash reserve goal card. And with this option, we can essentially tell the system how much we want to keep in the cash reserve. Maybe $40,000 as our target amount. We can tell the system how long we want that cash reserve to be in place. So if we want that to be throughout the duration of the plan, we can tell the system to start immediately and then continue that on through the end of both clients' plans. And if we want, we can even add an annual increase. Maybe we want to see that cash reserve increase along with general inflation, for example. Once I save this card, we can click back into our retirement cash flows, take another look at our accounts tab here, and we see that instead of simply reflecting the the bank account balance as the cash reserve, we see the dollar amount we entered into that goal card, that $40,000, as the starting point for our cash reserve, plus our inflation rate that we indicated as well. So the main thing to keep in mind is that in a case like this where the cash reserve goal that I entered is lower than the current balance of their bank accounts, what happens in those cases is it will actually take the excess and reinvest that into the taxable investments. So we can actually see that movement of money happening from the cash reserve into the taxable investments. So that's where that ends up in those instances. The main thing to keep in mind with the cash reserve option is really to just remember to actually add the goal card for that cash reserve. That's a super important step of this process. And if you accidentally delete this card or leave it set to $0, the system will actually see their cash reserve amount as $0, and it will actually automatically invest all of their cash, which is of course not what we want to occur within the plan. So just something to be mindful of, when you're using that cash reserve option, definitely double check to make sure that you're, specifying that cash reserve goal in the profile goals area. I'm going to switch this back quickly to the treat bank account as cash option. Perfect. So that does cover it for our top 6 settings here on this page. Of course, we are going to touch on the rest of the settings on the bottom half of this page. These settings are still important, of course, but in general, they're a bit more case by case. The rest of these are a little bit more situational, I'd say. So starting with this first setting here, distribute investment income from taxable account. What this setting is going to do is automatically distribute investment income, which is the interest and dividends from their taxable investments within the plan. So if you do want to see something like that occur automatically, you can choose to have that start right away and occur every year, or you can set that to start in the year that the first client retires within the plan. And when we add that, when we select one of those options and take another look at our cash flows, we'll see an additional column actually in the cash flows summary page, specifically within the income inflows column. We'll see this new investment income column appear here, and that's where that investment income is, those interest and dividends are going to appear as an inflow within the plan. The next option here is for HSA distributions. So somewhat similar, we have the flexibility to tell the system when we want those health savings account assets to be used within the plan when we want those to kick in and start funding those medical expenses. So, you can always have those start immediately, but you also have the flexibility to either select certain milestones or a specific calendar year to have those HSA distributions occur. So, just as an example for you, I do have this set currently to start funding medical expenses immediately. So what that's going to look like is in our cash flows, as soon as those medical expenses begin, we're going to see those HSA distributions start within the plan. So let me actually re-include the HSA within this client's plan so we can see that happening in our cash flows. And then if we take another look at the planned distribution column of the summary page here, this is where we'll see those HSA distributions. And I have the retirement healthcare expenses kicking in at age 65 in this plan, and that's when we start those HSA distributions as well. But again, if you ever wanted to change the start date of those HSA distributions, this setting is where you'd be able to make that change. Perfect. Our next setting here is going to be the retirement expense timing, which essentially just is a way to tell the system when we want to switch from pre-retirement living expenses to retirement living expenses. So as a reminder, within the profile section of the client plan, there are two different living expense cards. In the profile expenses tab, there's a card here for the pre-retirement living expenses, and then in the profile goals tab, there's a separate card for the retirement, the post-retirement living expenses. And that switch automatically occurs in whichever year the clients retire. So, in this case, at age 65 is when I have these clients set to retire, and we'll see that automatic switch from the $5,000 pre-retirement monthly expenses to the $6,000 retirement monthly expenses. But in cases where you have your clients retiring at different ages, you can always tell the system, do we want that switch to happen when the first client retires or when the second client retires? So that's really all this setting is doing for you, is giving you that flexibility to determine that switch in the living expenses. Perfect. Moving on to these checkbox settings at the bottom of the page here. The first one of these is include bank accounts in the asset allocation chart. So this is something that will impact the investment asset allocation tab that we looked at a few minutes ago. And the important thing to keep in mind here is that this is purely a visual change. If we want to see the client's bank accounts included in their current allocation pie chart here, we have the flexibility to include those in the visual, but that will not impact the returns used in the retirement projections. It's just a visual change within the investment asset allocation tab here. So if I refresh my page, we should see an increase in cash in this portfolio as a result of including that client's bank accounts. Right, the next setting here is to take annuity RMDs from IRA accounts first. So again, this is a little bit more of a situational setting for clients that have qualified annuities. If the annuity has a lifetime income rider that doesn't begin until after the client's RMD age, you can choose to satisfy the qualified annuity RMDs with IRA assets until that income stream begins. So if you have that situation occurring within a client plan and you did want those, annuity RMDs to be satisfied by IRA accounts rather than the annuities, you are able to check this box to make that change. I did skip over one by accident here, the allow display of scenario-specific cash flow settings. So we'll take a look at this one really quickly. This is a setting that is going to enable you to select custom return scenarios within the cash flows tab. So let me navigate back to our cash flows here so we can see what checking that box will do for us. Just as a quick refresher on return scenarios, those are essentially custom sequences of return that you can curate back in your advisor portal. And you can take a look at those in a couple of these retirement analysis subtabs to see the impact that will have on a client's plan. So I have a couple custom return sequences here, some market crash scenarios and things like that that I can, select and view the client's plan within the context of those scenarios. And if you ever found yourself in a situation where you wanted to use those scenarios to visualize those sequences of return within the client's cash flow tables, that's what checking this setting is going to allow for you to do. So if I click save and then refresh my cash flows here, we're going to see a new option appear right here next to the plan selection, where we can now choose what scenario we'd like to view. So the baseline scenario is just the return assumptions, essentially. So whatever your return assumptions are that you've dialed in into your advisor portal, those are going to be used for the baseline projections, and that's going to be a linear growth projection. It's a straight line projection without any volatility factored in. But by enabling these return scenarios here, that gives you the ability to inject some volatility into the cash flow tables. We're suddenly able to view any of our scenarios that we've created here and see the impact that that would have on the client's cash flows. So just an additional layer of flexibility for you there. Perfect. So the next setting we're going to look at here is the rebalance across account types setting. And this one has a rather long description here, but just to summarize, what this essentially will do is, instead of treating the client's current allocation as a blended overall allocation, which is how the investment strategy typically works in RightCapital, this is instead going to cause each investment type to have its own specific rate of return. So taxable accounts will have their own respective rate of return, IRAs will have their own rate of return, so on and so forth. So, instead of using that blended, annual return percentage that we took a look at back in the investment module, this overall current allocation, it's instead going to use individual return percentages for each account bucket, essentially. So that is certainly an option that you can choose to utilize for certain client plans if you'd like. The main thing to be mindful of with the rebalance setting is that if you uncheck that box, it does prevent you from being able to propose new asset allocations for a client. That rebalance function that sort of blends all of the client's assets together is the function that gives you the ability to propose a new model portfolio as the proposed investment strategy for a plan in the retirement section. So just be mindful that if you do uncheck that rebalance setting within the the settings page here, the one thing that will do is prevent you from being able to propose a new asset allocation. Moving on to our next setting here, we have the ability to use taxable accounts to fund IRA and 529 savings, specifically in years where the clients don't have the available cash flows to make those savings happen. So something to keep in mind is that in general, RightCapital will not allow you to make savings in a given year if the clients don't actually have enough income to make those savings. But when it comes to IRA, Roth IRA, and 529s and other education savings accounts, we can choose to liquidate taxable assets to fund those accounts in those years where they may not have the required income to make those savings. So this is something that's checked off by default. So this will occur, automatically unless you've unchecked this box. But you can choose on a case-by-case basis whether you want that to happen. Our other setting that impacts 529s and other education savings accounts is this last setting here in the bottom left to use 529 accounts to fund pre-college education goals. So this is one of the newer options here. If you have pre-college goals within a client plan, you can choose whether or not you want their 529 assets to be used for those pre-college goals. So by unchecking this box, you're essentially saying, don't use the 529s for the pre-college goals, save those for the college goals. But again, if you did want to use the 529s for those pre-college goals, you can always choose to do so as well. Our last two settings here in the lower right corner, these settings are specific to the modified cash flow based planning method. So if I were to select cash flow based here, for instance, these two settings will actually vanish. You'll only see those if you're using the modified cash flow based option. And these are both going to have an impact on the plan. This first setting is purely a visual change in our cash flows. But if you wanted to see the taxable savings moved from the net flows column in the far right to the planned savings column in the cash outflows area, you can check that box to make that visual change here. This is really just a matter of preference. Some advisors do prefer to see all of the client's savings all in one place, including taxable savings. So, if you did ever want to see that moved over into the planned savings area, that's where you can check that box. The last setting here is when we're using modified cash flow based, going to determine whether or not RMDs and other distributions are automatically saved or spent within the plan. So as a reminder, modified cash flow automatically spends excess cash flows, but this last setting here gives you, an additional layer of flexibility, specifically when it comes to RMDs and other distributions. So with this box unchecked, it's going to, save and reinvest excess from RMDs, which is what we see happening here in these latter years once the clients hit RMD age. But if you did want to, spend off the excess from the client's RMDs, you can always check that box, and then it's going to be treated like the rest of their income surplus. Instead of saving, the excess, we're spending that off here in the spend unsaved cash flows column. Perfect. So that does cover it for all of our methodology settings within our client plan. I do want to quickly navigate back to the advisor portal and highlight specifically the client presets area. So in addition to the advisor portal where we can make those changes to the methodology settings at the client level within the plan, in the advisor portal, we can also set the default selections for all of those same settings at a global level. And in order to do that, we can navigate to the client settings tab of the advisor portal and click into this client presets area. So one thing to note, client settings, depending on your account setup, might be in this upper menu bar here, but if you have some additional features enabled, it may be tucked away in this more menu. So just something to keep in mind. If you don't see client settings on your screen, you may have to click into this little 3 dots icon here. But once you're here, you'll find this client presets tab. And on this page, you'll find every single setting that we just walked through within the client plan. So all of the same settings, you have complete control over what you want your default selections to be for all of these settings. And if you find that you are starting to have preferences in terms of what settings or what options you'd like to select for certain settings for the majority of your clients, you can choose what you want the defaults to be here. And once you make a change here, for example, if I switch from modified to cash flow based and then click save at the bottom, going forward, every new client plan that I create in RightCapital will have the cash flow based planning method selected by default. So this just saves you, some time in terms of dialing in settings if you have a specific set of selections that you prefer to use for the majority of your clients. One thing to note here, this only affects new clients, not existing clients. So you don't have to worry about, if you make a change here, it won't change any of your existing client settings for your book of business. So no need to be alarmed there. This is only going to apply to new clients that you create going forward. Perfect. The very last thing that I want to highlight here before transitioning over to the Q&A for today is the notifications and permissions areas of the client settings tab here. So these are really going to be relevant if you are inviting clients to have access to their RightCapital plans. And in particular, these aren't going to change anything calculation-wise within the plan, but this will impact your client's experience in RightCapital. You have a lot of control here over how frequently clients are notified for things like upcoming tasks, vault uploads, and things of that nature. And you can also choose how much ability your clients have to add and edit their own tasks and budget categories as well. So just something to keep in mind here, you do have the ability to tailor these depending on what you would like your client's experience to be in RightCapital. Maybe if you want them to receive notifications a little bit less frequently, you can uncheck some of these boxes. You can switch overdue tasks from a weekly to a monthly reminder, or so on and so forth. And then in terms of permissions, if you want your clients to be able to add and edit their own tasks and budget categories, you can allow them to do so. Or if you'd prefer to be the one to, make those sorts of changes, you can uncheck these boxes. And this is a global setting, so this will apply to all clients that you've invited to have access to their client plans.